Thanks, Jason. I'll try to keep it short since I know we're running a little bit behind. Good afternoon, everyone. My name is Alex Cate. I'm the Director of Entrepreneurship Programs for Hudson Alpha Institute for Biotechnology. Hudson Alpha is excited to sponsor this keynote investor panel featuring leading venture investors in the Southeast. At Hudson Alpha, our mission is to develop and apply scientific advances to health, agriculture, learning, and commercialization. As a leading nonprofit genomics research institute and commercialization-focused campus, Hudson Alpha's faculty investigators and the more than 45 associate companies co-located at the institute are bringing innovative technologies and therapies to market in order to improve the human condition. Founded in 2008 by Jim Hudson and Lonnie McMillan and located in Huntsville, Alabama, Hudson Alpha is now features nearly 600,000 square feet of wet lab and office space for emerging and mature biotechnology ventures to operate and grow in place. Please come find me or any of my colleagues over the course of the conference if you're interested in learning more about our ecosystem or ways to collaborate with our faculty. And with that, I will now hand it over to Michal Preminger, Regional Head of Johnson & Johnson Innovation for East North America, to introduce the panel. Thank you.
Introducing yourself, and if you don't mind, provide a quick description of your organization as well, your investment thesis, mechanism, scope, and the stages in which you would like to invest, and then we'll go through that with the audience as well.
Sure. Everybody hear me okay? First of all, it's great to see everybody in person. It's nice that everybody can be in a room together and appreciate the personal interactions. So thank you for all that were vaccinated and were able to make it here. It certainly makes interactions much more enjoyable than they have been over Zoom for months. So I'm a partner at HealthQuest Capital. We are a healthcare investment venture capital fund. We invest in growth capital companies across healthcare. So we invest in medtech, healthcare IT, diagnostic companies, digital therapeutic companies, even kind of consumer-based companies. We have about $900 million assets under management. The latest fund that we're investing out of is a $450 million fund. We have a few partners that are in Florida, one in Atlanta. One of my partners who's actually here, Anthony Williams, is in Texas, along with another one of our partners, and we have partners in California as well. So it's a pleasure to be here with you, and look forward to a lively discussion.
Sure. First of all, welcome to South Carolina. It's so nice to have you all here. There is so much happening here, and I hope you're getting a taste of it. I'm from Good Growth Capital. We are the most active fund in the state. We're not the only fund in the state, but we're happy to talk to you about all kinds of great things that are happening in the region. We actually have 2 portfolio companies presenting at this conference, Obsidio and Lindy, and they're doing fantastically well, one from North Carolina and one from here in South Carolina. So happy to talk to you about that. I know there's a lot of entrepreneurs in the audience. I was an entrepreneur. My background originally was starting companies with scientists out of Harvard and Cambridge and MIT. So I have full sympathy for the fundraising process. Please feel free to ask questions after the panel as well. Good Growth has a pre-seed and a seed stage fund, and in that pre-seed fund, we will really look at things right out of the lab, and then we have a second larger fund that's seed through Series A. Our investment thesis really is to have a huge amount of operational and technical expertise at the fund. So when we invest in a company, we really feel like we know how to help grow that company, and we're very hands-on with our portfolio companies. We also will be doing things in the pre-seed fund from licensing the technology on all the way through. We have companies that have been growing very rapidly in the portfolio, from small seed rounds with a capped note through to now several that are going public in the portfolio or having big exits. We're in the middle of raising our 3rd fund at the moment, and we do about 45% health tech, 20% green tech, and then 55% data sciences. I know that added up to more than 100, but a lot of times there's some overlap.
Thank you, Amy. Jeff, I invite you to go next.
Hi, everybody. I'm James Ramey. My first time in Charleston, so thank you, and great to be in person with everybody. I manage VTC Ventures. We're about a $60 million AUM fund focused primarily on healthcare. We invest in pharma, medical devices, some diagnostics, and some healthcare IT. We also are very active in food and ag. We invest in the seed stage through basically Series C, so we can go as low as about $100,000 per check on the low end, and then up to about $2.5 million, and we can put about $6 million to work over the life of an investment. We like to syndicate all our deals. We're happy to lead or follow. And all our companies need to be in the greater Virginia Tech Carillion ecosystem, which is a pretty convoluted way of saying, if we can find a way to get a company to work with one of our LPs, whether that's a clinical trial, sponsored research, you name it, we can usually make good companies fit. And not that we're competing, but I've got 4 portfolio companies here, so it's been a great program so far.
The more the better, come on. The more the better. Great. Well, thank you. So obviously we have a beautiful group of experts here, and so let's dive into that Silicon Valley Bank data. So we have heard this morning, we've seen data that indicates the amount of capital, the key investors, the sectors that attract investment, the emerging fields, and here we'll attempt to translate some of this into actionable information for our audience. So identify which sources of capital are relevant in our region, and map which are the best match for each stage, and also try to compare what was discussed in that presentation with the reality here. So I'm going to invite you to make pretty open comments about all of this, and maybe we'll start in a different order this time. I'll start with you, Amy.
I'm sorry, did you say start with me?
Yes.
Yeah, I think that the reality here in the Southeast still for entrepreneurs is that, relatively speaking, it's a capital desert. It can be hard to be funded here. And I do feel that the capital availability, no matter what anybody says, has not kept pace with the growth, the economic growth, the entrepreneurial growth. I was just speaking to the head of the South Carolina Research Authority. Those kinds of regional economic development authorities are really important here in connecting people together. We were joking, but I don't think any source of capital here thinks of itself as a competitive source of capital. Where in Silicon Valley, I'll hear people talking about competing for deals. Here we're talking about collaborating on deals, syndicating deals, and trying to actively also bring in other sources of capital and help that throughout the region. I think everybody here would agree.
Yeah, I was just reading something the other day where 80% of biotech and med tech companies and service companies are outside of California, Massachusetts, and New York, but yet 80% of the venture capital is invested in those three areas. We've got about 20% of our portfolios in the Southeast. 80% of our portfolio is outside of those three countries, or three states. I think it's changing, and I think, the reality of COVID and hybrid and Zoom has helped open up borders, because I think a lot of that money didn't travel very well outside of those regions. We had always had a focus on it. It was actually started, HealthQuest was started really here in the Southeast. And so we see a lot of value, especially outside of biotech and med tech. I mean, you're not going to compete very easily in biotech with Boston. It has become the global biotech hub, early stage hub. I mean, there's lots of great technologies, biotech technologies anywhere. But you see more and more of those companies go to these huge funds in Boston and in New York, et cetera. But in healthcare services, healthcare IT, digital therapeutics, med tech, a lot of these other opportunities, especially here in the Southeast. You've got Nashville as a big hub in the services. You've got Atlanta it's really becoming a big hub in healthcare IT. In Florida, we're seeing more and more cybersecurity and healthcare IT in Tampa, where I live. Certainly Miami has got a really growing, opportunities as well, not to ignore South Carolina, but I'll give pitches for the other Southeast states. And so I think COVID has allowed capital that didn't travel well to start to travel a little bit more, and it is being attracted down here to the technologies in the Southeast.
I'll just, before you go, give a pitch for our sponsor, who I don't know, but we also have an office in Boston and see a lot of biotech coming out of Boston. But as soon as he started talking about wet lab space in Alabama, my ears perked up, because we need that. And the Boston companies, there's just not the facilities there. So I think that's a real opportunity for the region. So wet lab space, thank you.
Yeah, I echo that. We could definitely use more of it in Virginia for sure, but making a lot of good inroads, particularly with the J Labs in Northern Virginia. Thinking about SVB's speech or presentation earlier, and what both of you have said, I mean, that's basically our investment thesis in a nutshell. So, we invest around the country. We think that we know that there's a very strong Pareto distribution for capital in basically two cities, but that IP doesn't follow that distribution. IP is much more widely distributed, and so we've built several funds around investing off the beaten path, helping these companies grow to a point where they become appealing to some of those deeper pockets and larger sources of capital. So, love syndicating around that thesis, and I don't think we need to compete head to head against those regions. I think we can build good companies here, and then effectively, flip them, for lack of a better word, to some of these larger players.
Yeah, one, if I could just add, is a funny story. When we were all operators before we became partners in funds at HealthQuest. And I was a CFO of a company in Tampa, and I went up to an LP meeting up in New York for a fund that won't be named. And we were in the ophthalmology space, and instead of saying, this was, how we build our portfolio, they called our company and our investment a geographic diversity play. And I'm like, we're in the United States, we're in Florida. I don't think that's happening anymore, I don't think. But it has been changing, and so I think it's changing very positively, especially with the funds that are really starting to pick up down here.
So I think this was a sober description of the situation. Can I maybe turn back to you for some solutions, some advice regarding how to actually access capital?
There's a lot of questions there, so I don't know if I'm going to be able to answer all of them. But, number one, I think as an entrepreneur in this region, which all of us are entrepreneurs in this region as well, owning and running a venture capital fund is a very different experience than running a startup. But, we're still all startup people ourselves. So we feel at least some of your pain. But I think at the end of the day, my advice is build the best company you can build. Solve the biggest problems you can solve. And if you execute well, the capital will come. There's a ton of money out there. There's less here than there is, in Boston and in Silicon Valley. But, everybody's looking for good investment opportunities. So, what does a good investment opportunity look like? It's, innovative science, solving unmet needs. And if you can just check, at least those two major boxes, you'll be able to find some kind of more localized capital, and we can help you grow your company to the point where you can tap the broader capital markets.
I think that was great advice. I'll add to that I'll tell entrepreneurs, nobody likes a shopped deal, they say. Don't just scattershot send your pitch to all kinds of funds. I would look to see what comparable companies have used as sources of financing, down to the level of the partner at the fund that helped grow that fund, and start that way. Now, a fund like ours, I have a very deep biomedical deal team. They're in it partly for the money, but mostly because they love technologies. They want to have an impact on human health. They want to have a clinical benefit for what they're, working on. And so, you don't have to be, first of all, you don't have to be perfect to pitch us. Please don't spend any money designing your deck. Tell us the idea and, everything that James was just talking through. But we'll try to point you in the right direction if we can, if we're not the right direction. I don't think this has to be as scary as people think it is. That being said, we see about 10,000 deals a year. We put about 500 make it through a screen to be in diligence, and then maybe 10 a year are funded. So it's, that statistic is tough. You want to really be solving a real problem in order to make it through that kind of gauntlet, I guess we'd say.
So we don't quite see 10,000 deals a year. I thought 800 was a lot, which is what we typically see. And we'll do 5 investments, and that's really terrible statistics if you think about it. But that means that we're tracking probably 790 companies year over year, many of which are too early. We're a later stage fund that, we need to put $15 million kind of minimum to work. So most of the companies we see are just too early. But we keep a network of earlier stage investors. We keep a network of accounting firms, of law firms. And these are sources of connections for earlier stage companies as well. And there's a ton of money out there. What I would do is, and obviously everything's kind of available to be seen as far as what focus areas are on the internet. You can find what investors are focused on, whether it's healthcare IT, whether it's medtech, whether it's digital therapeutics, whatever, or biotech. Make sure that you're doing a little bit of research ahead of time, and then go through some advisors and go through your local economic development group. I mean, their job is to go through AdvanSE and Southeast Life Science here. I mean, our jobs as a part of this, because I'm on the board here, is to help the smaller companies find the money and find the networks. There's a lot of resources that are out there. Unfortunately, right now, there's a lot of money that's out there. So I think, and I won't belabor a lot of the other points that have been made, but for us, it's really clarity of story, right? Just make sure you know what problem you're solving. You don't have to have all the answers, but you just have to be very clear in the problem that you're solving. We're later stage, so we invest in teams as much as anything else, because you should know what business and what opportunity that you're really focused on and honed on by the time you get to us. But you don't have to have all the answers, and we wouldn't expect you to. And in diligence, we're going to try to find as many holes as we can, but we also look at those as opportunities for us to add value. And so what I would say to also answer the question as far as what you should look for in an investor, one that's engaged. You need to have one that's not just going to give you money and then just show up at board meetings and pay attention to their other investments or their iPhone. One that can bring a network. We've had to build a network of advisors that includes like the ex-Surgeon General, CEOs of Optum Health, of Mercy Bonds Accords, et cetera, because we believe that that network is important to our companies. And I think any investor needs to bring that to their companies. We're also ex-operators, and we believe, at least in our opinion, that makes us better investors because we've been at your seats. One company that I was the CFO of, I got 38 no's before I got the first maybe. And they ended up doing a flat round, and we ended up getting money to take it to the next level in a biotech investment. So I would look at those things from a company's startup standpoint as far as your investors, and you should be able to talk to our CEOs and find out what they think of us. I think that's important as well.
I'll just add one thing that was within what you said. Did you hear how he said he had to put 15 million to work per deal? So if you look at the size of a fund, you can extrapolate backwards to about how much money they have to put it to work. I'm mentioning this because it came up twice now in conversations that I've had at this conference, where I think what you might think you want is one of the big multi-billion-dollar funds. But if you're never going to raise $20, $50 million or whatever their minimum is, you don't want one of those funds, and they can't fund you. And even if they can fund you, they won't be able to give that kind of attention because they have so many bigger deals that they're worrying about. So I think that's one other piece, is to think through. There's a sort of a size of investor thesis that you should understand before you go pitch a fund.
So earlier this morning, we heard of some differences in terms of early stage funding between the sectors. So specifically, for example, for MediBios, there was mention of angel investors, and then some opportunities maybe for corporate venture. Anyone wants to talk a little bit about that?
I'm not sure I understand the question, but at a high level, I mean, if you think about your company in terms of step functions, where if you're in the clinic, you're at a very different point in your development than when you just have some early animal data. I think angel investors, especially quote unquote smart angels, meaning angels that have good connections to funds, angels that have experience in the market that you're operating in, can be really beneficial. There's a lot of terrible angels, just like there's terrible funds, and avoid those when you can. But it's a lot of times avoiding a bad investor is tough when you need capital. So, and then with corporate VC, it's sort of the same thing from my opinion. The one thing to be careful of is, so if you get a corporate VC, it's a great point of validation. So I myself as an investor, if I see, a CVC on the cap table, I view that as, wow, you've got a potential acquirer on your cap table already. That's great. The flip side of that is sometimes a corporate VC doesn't want you taking money from other corporate VCs, or, they want the company to go into a direction that matches their parents', strategic vision. So be cautious about your board, and be cautious about how much veto power your cap table has over you. But that applies across the board, whether it's corporate or angel or VC.
Now I'm thinking I'll be that for Halloween, a terrible angel. Sounds really good.
A couple of other points. Family offices have gotten very, very active and very large, and some of them you can. There's actually groups that will organize family offices for pitches, et cetera, so you can find that information. And they're great sources of capital, and obviously they've been most likely successful innovators and entrepreneurs themselves. Although it doesn't always track to your type of investment. They may be interested in healthcare but know nothing about healthcare. So just be clear, and a lot of times you'll find, and we'll find that I know two companies right off the top of my head that have been caught in valuation traps where their valuations have gotten so high because the family offices have given you, great money. And by the way, you want to try to get as much value as you can. But remember that, as investors, we're here to make some money as well, and you've got to keep that in mind as you're pitching your investors. What's next? We always look at how's this thing going to exit and work backwards, and if it's going to exit at 200 million and your last money was 200 million, well, we're not going to invest. And you could be caught, and a recap is painful because I've been through several of those as well, and so be cognizant of that. I would agree on the strategic VC and the corporate VC. They're also becoming more aggressive, and a lot of times there's a good fit with a science or a technology, but most of the time they don't want to lead around either. They'd like to have someone else come in. So I think they're great to have. I think be careful about having strings, right of first refusal, right of negotiation. Sometimes they're great because they are the natural acquirer. Just make sure that you keep them honest so that they don't, pay less value than what they should be paying. And that's the balance you've got to keep.
One thing to add too is be really cognizant of your investors' ability to do follow-ons. Some corporate VCs, don't do follow-ons as much as a traditional VC fund does, and same with angels. Eventually they kind of hit a ceiling, but you're always going to hit a rainy day, so you want to make sure that your investors have the ability to, kind of pass the hat around. This is why we syndicate. It's much easier for 3 or 4 funds to write smaller checks than one fund to write a much larger check. But follow-on investment is probably one of the most important things to ensure a company's survival and ultimate success. So make sure that your investors are very committed to follow-on investing.
I'll just
Validation. So I just wanted to maybe elaborate on that a little bit. I think that one thing that I'll add maybe to the advice that was given already is to reach out and have conversations with your potential maybe larger company partners and your acquisition targets if you're in certain sectors early on, being less worried about the competition from these entities, which usually would look for innovation externally anyway, and just benefit from opportunities to hear what the end game looks like, what the data package looks like, it needs to look like, that would help shape your development path and put you on a better foot, both with investors and with those entities. And at J&J Innovation, we have a large team, and also Janet was mentioned here, which is present in Virginia, that is really dedicated to having those conversations and help figure out what the right path is. Many times, whether we would be investing or not, and I will compliment also many of our peers and competitors in industry who do exactly the same and are deployed across regions and available to have those conversations. But I think, Todd, you wanted to say something.
Yeah, I'm going to say something a little bit different because of what you just said there. I think what you said is absolutely correct. We always call these, J&J and these companies that would be acquiring the companies that we're looking at. I mean, it's an important part of diligence, and they also know more about their industry than we do. And so it is a critical piece to reach out, and it's part of their jobs, as you said, to know what's coming probably ahead of a lot of VCs. And they're great, they're great companies to build or at least learn from. Because their job is to keep an eye out for these technologies as well. Our job is to help fund them. And so I think, look, we're going to call them, so there's no reason why they wouldn't pick up the phone and listen to what you have to say as well, especially if you've got a really good idea. That's what I was going to say more than anything else, so thanks.
I'll echo that and add one more piece. So we usually have spoken to potential acquirers before we fund the company. And for you as an entrepreneur, you heard other people on this panel talk about kind of understanding what the round structures are going to be like for the full life cycle of your company. Where are the inflection points and what the exit's going to be? And so talking to someplace like J&J Innovation, an acquirer, and understanding what the likely size of that acquisition would be from the outset can help you backtrack to see what your funding rounds look like and how that could work.
That's great advice. Thank you. So let me just shift gears a little bit and put you guys on the other side of the table for a minute, because in our audience today, there are not only entrepreneurs, but also investors, and they're not only from the region, but also from other regions. So can I ask you to actually advocate for our region a little bit and maybe shed some light on what differentiators there are, what pockets of excellence, and what are some of the advantages of working with innovators and companies in our region, whether it's in terms of the clusters of technologies, the infrastructure, and also maybe valuations, which was touched upon early, where there is a valuation gap that may make some of our deals more attractive. Maybe I'll start with you, James, now?
So this is a really interesting question. And it's interesting because, valuations, like I said earlier, our fund thesis, is around investing in what has been traditionally VC flyover country, and helping grow these companies to a point where they can tap into broader capital markets. That can sound a lot like bargain shopping, and it's not. In reality, due to the way that capital has flowed to San Francisco and Boston, it's having an artificial effect on valuations. And so, my argument is that, companies here are not cheap. They're just properly valued relative to their risks. And, by investing by investing in exciting science at a good valuation, doing venture deals the right way, we can grow companies in a responsible manner that sort of decreases the risk of loss while smoothing out the gains. So, like our portfolio, as much as we love a unicorn, we don't need a unicorns to hit our IRR targets. We just need to minimize our losses. And I think that this region can be a very powerful tool in achieving that, because there's a ton of good science, there's a ton of smart people, and there's enough capital here to be able to get companies to the appropriate stage that you need to get to achieve an exit.
I have a team in here, so we have 4 partners here in Charleston, 1 in Boston, and then we have venture partners and advisors in Boston, Baltimore, North Carolina, Northern California, Southern California, and Chicago. So we really see what's happening across the country. And I will tell you that we see great deals in the region. Are there as many great deals in the region as there are in biotech in Boston? Absolutely not. But there are certainly enough to build a fund of our size around. Are there enough deals to build a multi-billion-dollar fund around? No. But, as we were saying, you don't need to have a multi-billion-dollar fund. I think that if you look at the exits even that have happened recently in Charleston, there are multiple IPOs, multiple successful sales, not necessarily $10 billion exits, but $650 million, $300 million kinds of exits. Those are great returns as long as you're investing properly. And I agree about the valuations. I think the valuations here are on target. And that also means that there's more opportunity for an investor to have exits and realizations that are on target. Honestly, when I see a company come to us from California, I think, why? They have to, and we have 4 or 5 companies in our portfolio that are from California. They're all very specifically companies where there was a long-term relationship, or there was something about the experience on our team where that CEO wanted us to help them grow the company. Otherwise, I'm not interested in investing in a deal in California. Why couldn't they get the money there?
Yeah, I mean, as I mentioned before, I mean, we were kind of started with the idea that there was value in places other than Boston and San Francisco, which is why we started in the Southeast and why most of our partnership is in the Southeast and the Midwest, and why 80% of our deals are not in those areas. And so we've always been a big believer in, you know, innovation and technology outside of the big, you know, two areas in particular. I think, to echo the point, you know, biotech is a different model, but there's a lot of good biotech coming out of RTP in Miami and things like that. Typically, that gets moved or acquired early on. I mean, you can get the, you know, $8-10 billion exits in the Southeast. They're just going to be service industries. They're going to be healthcare IT industries. There's going to be a roll-up of things like, you know, we invested in a company called 30 Madison. They happen to be in New York, unfortunately. But, you know, they're changing the way that we interact with, you know, various chronic diseases, more of a retail or DTC, and that could be anywhere. You know, it didn't have to be in New York, it just happened to be, but certainly you have Roe and Hims and those other types of things. And so, you know, I think, and people are obviously moving away from those areas for all kinds of fantastic reasons, and money is moving away from those areas because innovation is here in the Southeast. And we have a, you know, great, very diverse, you know, workforce that just need to be tapped into. So, you know, I think it's just going to continue to grow here in the Southeast. We're very bullish on the Southeast. And so, you know, I think that money will continue to evolve and grow, and it's going to be an uptrend.
Thank you all, and I just want to double down on that last comment. We at Johnson & Johnson are very focused on diversity. We're trying to mirror our target patients, which is everyone, into our workforce, into our partnering, in external investments, and of course also serve beyond that the communities. And we do believe that that innovation is driven by diversity. And so I think you're cynically saying, you know, geographical diversity, but I think diversity of backgrounds and approaches and thought processes and styles, as well as geography, are very important. And with the optimistic overview that you have just given of all the strength of the region, I just want to congratulate everyone out there, all of you innovators and investors, for making the Southeast region as vibrant as it is. And thank you, and enjoy the rest of the conference. Thanks, everyone.
Thanks, Michal.
Thank you.
All right, thank you very much. Unless y'all want to stay on for the next panel, you're welcome to. All right, ladies and gentlemen, don't go anywhere. We have our next session in this room, starting here in about a minute. I still see people leaving. What we have next is our Southeast Color. We're missing Jamaica? Okay. All right, ladies and gentlemen, if I could have your attention. Tina, I need you to clink a glass for me. Thank you very much. All right. We are going to start our next session now that is in this room, so no need to go anywhere. They will be cleaning up the plates, I imagine, but we're staying here. We have our Southeast Color presentation and panel discussion. which is sponsored by Moderna, who has become a very strong supporter of Southeast Life Sciences. So not only are they saving lives with their vaccine, but they're certainly supporting us very strongly. So I'd appreciate that. For our presentation today, we have Tiffany Whitlow with Acclinate, who will be moderating our panel, Pierre Theodore in the Global Health at Johnson & Johnson, Jamaica Hill, who is the Director of Diversity at Moderna, and then Jane Morgan with Piedmont Healthcare, also the Southeast Life Sciences Chair and CNN personality. So we'll switch it over to webinar.